Imagine this. Over 100 years ago, Jesse Livermore, nicknamed the Great Bear of Wall Street, was battling markets that could make or break fortunes overnight. He lived through the panic of 1907, the wild bull market of the Roaring Twenties, and the devastating Great Crash of 1929. His lessons weren't learned in theory, they were carved out of triumphs and failures worth millions. Now fast forward to today. We live in an age of supercomputers, algorithmic trading, artificial intelligence, and 24/7 global markets. Yet despite all this technology, some of the most successful traders and fund managers still lean on the very same core principles that Livermore discovered a century ago. Take Paul Tudor Jones, the legendary hedge fund manager overseeing more than $8 billion, who has repeatedly emphasized psychology and risk management as the bedrock of his trading. Or Mark Minervini, a two-time U.S. investing champion, who openly admits that many of his strategies trace back to Livermore's timeless wisdom. So here's the big question. Why do Jesse Livermore's strategies still work in today's market? And even more important, can you apply them to profit in the years ahead? Let's break it down. 1. Markets are driven by human psychology. Jesse Livermore's most famous belief was that markets are not governed by numbers alone, they are governed by human emotions. Fear, greed, hope, and panic can overwhelm even the most rational analysis. What mattered in the 1920s still matters in 2025. People, not spreadsheets, move markets. We saw this vividly during March 2020. As the COVID-19 pandemic spread, the S&P 500 fell nearly 34% in just over a month. That collapse wasn't about quarterly earnings or cash flow. It was raw fear. Investors rushed to sell, not because they carefully calculated future profits, but because they were desperate to avoid further losses. And yet, just months later, hope returned. Fueled by massive stimulus packages and investor optimism, the market recovered at record speed. Fast forward to today, September 2025, the S&P 500 trades around 6,500 points, almost 3 times higher than its pandemic low. Along the way, countless stocks multiplied several times over, some by dozens of times, and in rare cases, even by more than 100-fold. Such outsized gains may seem unbelievable, but they are the natural product of human psychology, driving waves of panic and euphoria.
Livermore understood this cycle perfectly. He once said, "The game of speculation is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, or the get-rich-quick adventurer. They will die poor." His warning was harsh, but it rings true today. Without emotional discipline, traders self-destruct. The same dynamic is easy to see in crypto. Bitcoin crashed from nearly $69,000 in late 2021 to under $16,000 in 2022. Many declared it dead. But as of September 2025, Bitcoin trades above $111,000 per coin. The blockchain didn't suddenly evolve overnight. What changed was investor psychology. Fear turned into despair, despair into hope, and hope into greed. The bottom line is this: markets are a mirror of human behavior. To understand price action, you must first understand people. That's why Livermore's insight is timeless and why it still guides traders who succeed today.
2. Trend following is timeless. Jesse Livermore built his fortune not by predicting every twist and turn, but by riding powerful trends. He famously said, "There is nothing new in Wall Street. There can't be, because speculation is as old as the hills." He understood that once a stock or a market began moving in one direction, that move would often last much longer than most people imagined. This principle is just as true today.
Trend following remains one of the most profitable strategies in finance. Some of the world's largest hedge funds, such as Winton Capital and Aspect Capital, have built multi-billion-dollar businesses by applying systematic, rules-based trend-following models. They're not trying to predict the next headline or guess earnings reports. They are simply following the flow of prices, just as Livermore did more than a century ago.
Consider the example of Tesla. Between 2019 and late 2021, Tesla's stock didn't just rise, it skyrocketed by more than 3,000%. Traders who recognized the trend and had the discipline to stay in the trade saw life-changing gains. Those who fought the move, shorting the stock and betting on its collapse, were left with devastating losses. Livermore would have called that fighting the tape, a mistake as old as the markets themselves. The lesson is straightforward. Don't fight the tape. If the market wants to go higher, let it. If it wants to trend lower, either step aside or ride the wave down. The strategy may be old, but the money it produces is always fresh. And why does this work? Because price movements are reflections of investor psychology. When large numbers of investors are willing to pay higher prices than yesterday, the stock rises. When fear takes hold and they rush to sell at lower and lower levels, the stock falls. Trends, therefore, are not mechanical quirks. They are the visible footprints of collective human behavior. 3. Cut losses quickly. Perhaps Jesse Livermore's most enduring rule was this: always cut your losses. He understood that no trader, no matter how skilled or experienced, could be right all the time. The real key wasn't about predicting perfectly, it was about survival. Protect your capital so you can fight another day. This principle has been proven countless times in modern markets. Take the example of Bill Ackman, the billionaire hedge fund manager behind Pershing Square. In the mid-2010s, Ackman made a massive bet on the pharmaceutical company Valeant. At first, the stock soared, and his conviction grew stronger. But when cracks began to show in Valeant's business model, instead of cutting his losses, Ackman doubled down. He held on for too long, refusing to admit defeat. By the time he finally exited in 2017, Pershing Square had lost more than $4 billion on Valeant, one of the most painful lessons of his career. The mistake wasn't being wrong initially, it was failing to cut the loss early. On the flip side, look at retail traders who piled into meme stocks like AMC and GameStop during the 2021 frenzy. Many bought at the peak, convinced the short squeeze would continue forever. When the momentum faded, instead of cutting losses, they held on, hoping for a miraculous rebound. Most of those gains evaporated, and many small traders were left with portfolios that never recovered. Livermore himself knew this lesson better than anyone. He once said, "A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking the loss, that is what does the damage to the pocketbook and to the soul." In other words, losses are inevitable, but refusing to deal with them quickly can destroy both wealth and confidence. The wisdom here is timeless. Cutting losses quickly isn't just a trading tactic, it's a mindset of humility and discipline. It's the recognition that the market is always bigger than any individual, and that survival matters more than pride. 4. Patience and timing. Jesse Livermore was not a day trader in the modern sense. He believed in waiting for the perfect setup. Sometimes he would sit on large amounts of cash for weeks or even months until the market confirmed his thesis. To him, patience wasn't weakness, it was discipline. This idea is incredibly relevant today. With thousands of stocks, ETFs, and crypto tokens available, it's easy to feel like you must always be in the market, always trading, always doing something. But the reality is that opportunities don't appear every day. They come in waves. The skill lies in knowing when to wait
and when to act. Even Warren Buffett, one of the richest investors in the world, has applied a similar principle. He's famous for saying, "The stock market is a device for transferring money from the impatient to the patient." Like Livermore, Buffett understands that successful investing isn't about constant activity. It's about disciplined inactivity until the right moment arrives.
One of the best modern examples is the breakout of Bitcoin in late 2020. For nearly 3 years, from early 2018 through most of 2020, Bitcoin moved sideways after its brutal crash from nearly $20,000 to under $4,000. Impatient traders gave up, convinced the crypto boom was over. But patient traders who waited for a clear breakout above previous resistance levels were rewarded. Once Bitcoin broke out in late 2020, it surged more than 500% in less than a year, eventually surpassing $60,000. The gains didn't come from chasing every bounce, it came from waiting for the right confirmation. Patience, then, isn't just about doing nothing. It's about waiting with intention, waiting for the setup, the confirmation, the timing. Livermore's lesson was clear. In markets, timing is everything. 5. Market cycles repeat. If there's one thing history proves beyond doubt, it's that markets move in cycles. Jesse Livermore experienced this reality firsthand. He lived through the panic of 1907, where liquidity dried up and panic selling gripped Wall Street. He traded during the bull market of the Roaring '20s, when optimism seemed endless. And he survived the devastation of the Great Depression, when markets collapsed and fortunes disappeared overnight. Fast forward to today, and the patterns remain strikingly familiar. The dot-com bubble of 2000 showed how excitement over the internet drove valuations into the stratosphere, only for reality to bring them crashing down. The housing crash of 2008 revealed the dangers of excessive leverage and speculation in real estate. The crypto boom and bust of 2017, followed again by the sharp rise and crash in 2021, are just modern versions of the same old story. The details change, but the rhythm is the same: euphoria, denial, panic, recovery. Even the world's top investors recognize this. Ray Dalio, founder of Bridgewater Associates, often speaks about the long-term debt cycle and how history repeats itself in predictable patterns. His framework aligns directly with what Livermore observed a century ago. Markets are governed by human nature, and because human nature doesn't change, cycles don't change either. For traders and investors, the lesson is clear. By understanding where we are in the cycle, whether it's the euphoria of a bubble, the denial as prices start to slip, the panic of a crash, or the slow grind of recovery, you can position yourself not just to survive, but to profit. Livermore knew it then, and it remains true now. The faces may change, the assets may evolve, but the cycles always repeat. 6. Position sizing and risk control. Jesse Livermore's approach to risk was far ahead of his time. He didn't simply bet big. Instead, he scaled into positions only as the market confirmed his thesis. In other words, he never went all in at once. He would test the waters with smaller positions and then add more as the trend proved itself. Today, traders call this method pyramiding. This principle is even more critical in the modern era. Markets move at lightning speed. News and data spread instantly across the globe. Leverage is widely available, giving traders the ability to control positions far larger than their actual capital. Without strict rules for position sizing, fortunes can evaporate overnight. A cautionary tale is the collapse of long-term capital management, LTCM, in 1998. This hedge fund was run by some of the smartest minds in finance, including Nobel Prize winners. but they ignored proper risk control and used enormous leverage to magnify their bets. When markets turned against them, the losses spiraled out of control, so severe that the Federal Reserve had to coordinate a bailout to prevent a global financial meltdown. Contrast that with modern trading legends like Paul Tudor Jones. Jones is famous for his strict risk discipline, often limiting the risk on any single trade to just 1 to 2% of his capital. By doing this, he ensures that no single bad trade can wipe him out. That philosophy mirrors Livermore's wisdom almost exactly. Protect your capital first, and then let profits grow when the market is on your side. The lesson here is timeless. Livermore understood it a century ago, and great traders still live by it today. Protect your downside, and the upside will take care of itself. 7. Discipline over prediction. Perhaps Jesse Livermore's most important lesson is this: discipline matters far more than prediction. He understood that no one, not even the smartest trader, could consistently forecast the market with certainty. What separated winners from losers was not their ability to call tops and bottoms, but their discipline to follow rules, manage risk, and act with consistency. Think about recent history. Almost no major analyst predicted the scale of the 2008 financial crisis. Few foresaw how quickly markets would collapse when Lehman Brothers failed. Likewise, in 2020, nearly everyone underestimated the speed of the rebound after the COVID crash. Forecasts were everywhere, but very few were right.
And yet, disciplined traders didn't need to predict the future. They survived and even thrived by cutting losses, riding established trends, and sticking to proven systems. Take Mark Minervini, one of today's most respected traders. He is known not for calling the market, but for his strict adherence to rules. His strategy emphasizes precise entries, clearly defined exits, and rigorous risk control. His success didn't come from guessing where the market would go tomorrow. It came from the discipline to execute his system without hesitation. This is the essence of Livermore's wisdom. Prediction is flashy, but discipline is what builds fortunes.
So, why do Jesse Livermore's strategies still work in today's market? Because they're not about technology or algorithms or secret formulas. They're about human nature, and human nature doesn't change. Markets will always be ruled by fear and greed. Trends will always run longer than expected. Risk management will always separate the winners from the losers. Livermore's principles are timeless, and they will remain relevant for as long as markets exist. So the real question is this: will you trade with discipline, patience, and respect for the lessons of history? Or will you ignore them and learn the hard way like so many before you? If you found this breakdown helpful, make sure to hit the like button, subscribe for more deep dives into trading psychology and market history, and share this video with someone who needs to hear it.